Welcome to Accounting 100. This is Instructor Green, and I am going to present this PowerPoint lecture over over chapter one. I'm sorry. And I'd like for you guys to take this information along with the in-class lectures and try to understand better what this chapter is all about. So, without any further ado, I'll go ahead and get started right into the chapter. Okay, so chapter one, we're talking about collecting and organizing information. And it says here that accounting is an information system that reports on the economic activities and financial condition of a business or other organization. So, what we're doing is taking information from a business or an organization, putting that information into readable formats, financial statements, to allow users of those financial statements to understand or better understand what's going on within that business or that organization. Okay, so let's look at our learning objective number one, to identify the ways accounting benefits society. The role of accounting in society. How should society allocate its resources? Should we spend more money to harvest food or cure disease? So these are just some of the decisions that are made when you talk about scarcity. Resources are always scarce. So there's always a decision to be made as to how those resources are to be utilized. And when it comes to money, there's always a conversation with what should we spend the money on. Other questions within companies would be, should we build computers or cars? Should we invest money in IBM or General Motors? Accounting provides information that helps answer such questions. And what the accounting information tells us is, well, looking at this particular potential investment, are we going to make money? Are we at a risk of losing money? Which one of the particular investments has a better chance of us making money? And all of those decisions are made based on the information we get from the financial records that are accumulated from looking within the business. So decisions are made based on the information that is provided through the accounting records. When we talk about market-based allocations, we're talking about a market that is a group of people or entities organized to exchange items of value. So where do we put our resources? Into which markets? Which group of people are going to benefit the most from our resources? Here's the market trilogy in resource allocation. So we're looking at three different things. We're looking at resource owners, conversion agents, and consumers. The trilogy, I guess, because tri meaning three. Okay, so resource owners are the people that own the actual resources. So if there's oil or labor, actual people that are doing the work, they have the resources to actually get things done. Those resources are then transferred to the conversion agents, your businesses. You know, some type of way those resources are packaged to be sold to consumers, and then finally the consumers are the one that use the resources. And again, when you go backwards, the consumers make profits for the conversion agents by purchasing their products at a markup, and then the conversion agents also are going to compensate the resource owners for actually providing them with those resources to sell. So everyone gets something. At the end of the day, the consumer is going to get what they want, and the conversion agents are going to make a little money by being conversion agents, and then the resource owners are also going to earn some revenue because they are the one that actually provided the resource. Common terms for the added value created in the transformation process. Added value means there's some value being added to this economic event or transaction. And one of those could be profit. We're going to make money. Okay, so a common term is profit, meaning that we've made more than we've spent. That's a profit. Income is not profit. Income means that's money that has came into the business. Okay, that's income. But again, you have your gross income and then net income after taxes are taken out. Okay, so therefore, income alone is not always profit because you have to take into consideration the taxes on that income. And then earnings is the money that you actually earn from operating your business. Financial resources. Conversion agents need financial resources, money to establish and operate their business. Companies don't just start by providing services without at least investing in their own business first in order to have the resources to provide those services. So there's always some type of financial investment that has to be made, borrowing, whatever the conversion agents need to do in order to establish themselves as a business. That could come from investors or creditors. So there are people that invest in particular businesses. So if I'm a business and I need money, I may go out to individuals and make them shareholders. Now they own a portion of my business as investors. And then there's also creditors. Well, I go to particular vendors, wholesalers, and say, hey, I'd like to purchase some of these items to sell in my store, but I don't really have money right now. Can I pay you later? So now I become a debtor and they are the creditors. Look at physical resources. In their most primitive form, physical resources are natural resources. Owners of physical resources seek to sell those resources to profitable businesses, which are able to pay higher prices and make repeat purchases. Okay? So if the physical resources can see where they can make money, then they're going to go to those actual businesses that are going to pay for those resources. So the business that's going to pay the most money for those physical resources are probably going to be the one to actually get those physical resources. Labor resources include both intellectual and physical labor. Workers seek relationships with businesses that have higher earning potential because these businesses are better able to pay high wages. So if I'm looking at a field to work in, I'm going to look at some of those fields, like accounting, for instance. There's a lot of money to be made in accounting. So I'm going to look in the accounting field and I'm going to go to work in accounting as an accountant, as a CPA, as, maybe a CEO of a company, a controller, a consultant. And that's because I know that I'm going to make a lot of money doing these things. So that's what workers do. And it could be not accounting. It could be someone that's not even looking at a so-called career. They're just looking for a job. They're going to try and find jobs that are going to pay the most money so they can survive and pay their bills. That's just, the way it goes. The types of accounting information, you have financial accounting, which is focused on the needs of external users, those users that are outside of the company. And then you have managerial accounting, which is focused on the needs of internal users, your managers, your employees, people within the organization that need to understand what's going on with the company. Your non-business resource allocation basically says that not all entities allocate resources based on profitability. Organizations that are not motivated by profit are called not-for-profit entities. So you have not-for-profit entities, meaning that they're not really concerned with making a profit. They are more concerned with servicing the customer, servicing their market. So it's nonprofit. Not that people don't get paid, because when you work for a nonprofit, you can still get paid and be on the payroll. It's just that the business is not to make a profit. The business is to provide a service or a product, whatever the case may be, to a particular market, and not necessarily to make a profit and grow the pot for the company. Okay, governments allocate resources for national defense to reallocate wealth or to protect the environment. Foundations, religious groups, and various benevolent organizations allocate resources based on humanitarian concerns. So again, we're not talking in these situations about making money. We're talking about putting resources where they can do the greater good. We look at accounting as a resource provider, okay? Accounting as an information provider. Accounting information, you have your financial accounting, your managerial accounting, your nonprofit accounting. Your financial accounting, your investors want to know what's going on. Your creditors and your brokers, they want to understand what's going on. So that information is, transferred external of the company to allow those investors, creditors, and brokers to understand what's going on within the company. Managerial accounting, again, we're staying within the company. We're talking about managers understanding, well, what's going on within the company? Employees, hey, how well are we doing? Do I need to look for another job? And then also the unions, so they can make and negotiate contracts with administration. And they would like to understand what's going on within the organization as well. And again, finally, you have your nonprofit organization, nonprofit accounting, your benefactors and your beneficiaries are who is going to be getting the money. The legislators are basically laying down the foundations of what should happen within a nonprofit organization. And then the citizens are concerned as well with the well-being of, where resources are being provided within a nonprofit organization. A lot of nonprofit organizations have boards. And those boards are their responsibility is to make sure that nonprofit organizations are allocating resources properly. Accounting improves communication. Accountants establish measurement and reporting rules that businesses use to facilitate communication. The Financial Accounting Standards Board, that's what FASB stands for. Those are generally accepted accounting principles that are made up by the Financial Accounting Standard Board saying, hey, this is the way that we're going to allow accounting to be done. So the generally accepted accounting principles are those principles that companies must abide by if they want to be in conformity with the Financial Accounting Standards Board. Different careers in accounting, you've got public accounting, you've got private accounting. Your public accounting, you're talking about certified public accountants. They provide audit services, tax services, and consulting services. And then you also have private accounting. Someone could be a certified management accountant, meaning they're just managing an organization. They can also be a certified internal auditor, meaning they're looking at the company from within. Learning objective number 2, identify reporting entities. Reporting entities, first of all, we have we have businesses, individuals, and organizations. Financial accounting reports disclose the financial activities of particular individuals or organizations described as reporting entities. Each entity is treated as a separate reporting unit. So a business can be taxed, a business can have its own financial statement, financial records, an individual can have their own financial records, financial statements, as well as an organization. Learning objective number 3, identifying the components of the accounting equation. Okay, here are different elements of the financial statements. You have your assets, your liabilities, equity, your contributed capital, revenue, your expenses, your distributions, net income, gains, and losses. Now, your net income is going to basically, be determined from a lot of, things. Okay, so not necessarily gains and losses, but, if you have an actual loss, then and you've actually lost more than you've made, you're probably going to have a net loss. You've made more than you actually spent, you're probably going to have a net gain, which is net income. Okay, but there's also other gains and losses as well, right? And just looking at these different assets or these different elements of the financial statements, you can see assets is cash, equipment, buildings, and land. And we go right into assets. Creating an accounting equation, your assets equals your claims. Claims on the assets are from 2 sources, either creditors, where you borrow those assets, or investors, where they invest in your company. Okay, we'll go ahead and finish the remainder of this PowerPoint slide in another session. See you soon.